stocks. All right, yields on high-yield debt have risen to their highest levels in over a year. Well, does that mean that investors should leave the security of U.S. Treasury bonds for the higher yields that may be on offer? Well, my next guest can give us some perspective. We've got Marty Fridson. He is a global credit strategist at BNP Paribas Asset Management. Marty Fridson, good to have you with us. And I just want to note also that you are the author of the introduction of the book Extraordinary
Popular Delusions.
Popular Delusions.
And the Madness of Crowns.
And the Madness of Crowns. If ever there was a day when you should revisit those titles, this is probably it. Give us a little bit of context right now for what's happening in the high-yield market. I mean, these are bonds. This is debt that is issued by companies that don't have investment-grade ratings and are then viewed, obviously, as being slightly more risky.
Right. Well, they are riskier and they yield more. And right now, that's very much in demand because the Treasury rates are so low. It has really been very painful for savers. You know, the people who did the right thing, saved their money, figured to get some income from their investments, very hard for them to find. So
yeah, I heard a statement that the 10-year is the new 2-year.
Yeah,
something like that, right?
Yeah, well,
2%.
Yeah, all-time record low in that auction. And so it has held up the high-yield market up until now, but it's gotten slammed along with all other risky assets in the last few sessions. We've gone in a period of 2 weeks from a little over 500 basis points spread over Treasuries. This is on Merrill Lynch's high-yield Master 2 index to a little over 700. And that same ground was covered in a period of 9 weeks in the last cycle. So as much as people are saying, well, it's different, we're not on the verge of a financial crisis, you have to stop and think when you see that deterioration happen as quickly as it has.
Has there been any fundamental change in the operational quality of the companies that are embodied in this index of high-yield debt?
Well, you can't really see it show up yet. It's really looking to the future. If we do slide back into recession, then they're definitely going to be affected. The saving grace there is that for the most part, they've financed out their debt maturities, so it'll take a while before they're really at the default point, with some exceptions. But fortunately, their balance sheets are in pretty good shape at this point.
So what are you telling clients? What are you telling customers right now who are interested in high yield, who follow the market?
Well, it's actually gotten to a pretty good valuation level. We have a model of the spread that I was speaking about a moment ago, and we can explain the variance in the spread on the basis of some measures of aggregate economic activity, the default rate, measure of the availability of credit, and we're definitely at an extreme. Yesterday's close was a spread of 719 basis points over Treasuries. The fair value by our model is only 470, and that difference easily qualifies as an extreme in historical terms.
All right, so let's eschew the diplomatic talk. Are these good buys right now? I mean, should people be thinking, if they were worried about not being able to catch some decent yield previously, is this a good time to be buying high-yield debt?
Well, I think as a short-term proposition, the market is oversold. If we do go into recession, then spreads will be wider than they are now. But right at the moment, by our analysis, the market is discounting of a 50% nearly probability of going into recession. Martin Feldstein, the former head of the National Bureau of Economic Research,
at Harvard University now.
Yeah, and he has put the probability there, but he's, as far as I can tell, the outlier. Most of the forecasters we've talked about, Wells Fargo, strategist, Lawrence Summers, the former Treasury Secretary, have put it at more like a 1 in 3 or 33% probability. So it looks to us as the market is overcompensating you for the risk that most people believe is out there at this point.
Last point for you. What about liquidity in the marketplace? Still good?
Up until today, it's been fairly good. Right now, it's trading on particular axes, particular names, where there's some activity. The sellers are not panicking and hitting any bid. The buyers are not too active right now.
All right. Always a pleasure to have you. Thank you very much for your insights into the world of high-yield debt. Marty Fridson from BNP Paribas Asset Management. Always a pleasure.